Okay, folks, welcome back. We are in price action model number 8. We're going to be talking about 6% trading model. It's per month as an objective with the expectation and aspirations of doubling equity over a calendar year. And we're going to be dealing with building the career with 25 pips per week. Okay, so the ICT price action model number 8. The 6% trading model, building the career on 25 pips per week. Now the stage is going to be framed on a weekly range expansion. Now if you've gone through the mentorship, obviously we know there's a generalized theme here. We're looking for the effects of liquidity runs in price action, and it's basically an expansion on the upside or downside. So if we're going to be looking for our objective of 25 pips per week, number one, let's start off with 25 pips is not a minuscule amount. Now, it's only minuscule if you compare it with the Instagram guys that tell you they make 1,500 pips every single month. I don't make 1,500 pips a month. I don't try to do that. I think it's too much work and effort required to do that. Could I make 1,000 pips a month? Yes, I believe I could. Do I want to put the work in that's required to do that? No, I don't. Okay, so you can call me lazy. I'm calling it a smart worker. I want to have my time free. Okay, so this model is designed to amplify what has already been explained in free tutorials, but also kind of like give you the nuts and bolts of what you've gleaned from the mentorship and simplify it in such a way where we don't have to try to grab every potential component that makes up my material and concepts. And in fact, that's the model for each unique model that you see here in the 12 and anything that we create in the future or that you've created on your own by way of using the mentorship content. So what I mean by that is we don't have to try to take the kitchen sink approach where we try to throw everything into our model. I get a lot of emails from members that are in charter membership, and they state that they're trying to find a place for COT, or they're trying to find a place for the standard deviations, or they're trying to find a place. You don't have to have every single component. There's a sweet spot for every specific concept. There are ways of making the model where you don't include every single thing. For instance, if you're going to be a swing trader, you don't necessarily need the intraday standard deviations. Central bank dealer's range, you don't need flout, you don't need the Asian range deviations whatsoever. You don't need that because it's a larger model. Obviously, as an intraday trader or scalper, day trader, you want to make a conscious effort to try to know something about the standard deviations because they do, in my opinion, nail down a level of precision that's unrivaled. But that's beyond the scope of this discussion. I just want to remind everyone, because I've got emails from several of the charter members, and their questions are, and I'm saying this about 5 members, it's not like the whole slew of you, but 5 of them had kind of like the same type of concerns. What about this, and why isn't it in the model? And it just seems like we learn things that aren't useful, or it's a lot of filler. No, it's not filler. It's things that I'm trying to start you off with rather simple models. They're foundational. Okay, so it allows you and I to come back to these later on and build on them. That's the intent of the 12 price action models. I'm not delivering these and say, okay, well, there you go. My answer, wipe clean of it. Now you have at it. I'm going to be building on these throughout our time together. I don't want to have any more than these specific 12 because it's a limitless, endless, really, amount of price action models that you can create. So I came up with 12 simply because it's 12 months in a year, and it gave me an opportunity to give 12 models for the members that come into the mentorship. So obviously the first class has to wait a little bit longer than would otherwise be expected. There is certain components that you have that will repeat in all the models, but then obviously there's other things that aren't going to always crop up. Okay, so when we first sit down with this model, we're trying to ascertain whether or not the weekly chart is indicating to us that it wants to expand on the upside or expand on the downside. Now, why are we focusing there? Well, because the weekly range allows a handsome amount of pips. Okay, the range is conducive for finding a very easy number of setups that would warrant your study and stalking of a 25 pip move. 25 pips, again, is not minuscule, because if we look at how trading started as, well, my start, if we looked at what I was trying to accomplish as an S&P trader, I was only trying to get 2 handles. It's at best 3 handles a day. And if I got 4, that was like a huge day. And it's not what you're trying to capture in terms of pips that makes you wealthy. It's what you do with the pips that you consistently make that makes you wealthy. So I say that to say that you can do a model that is 15 pips a week if you're inclined to say, okay, well, I just want to make it really easy for myself, and I'm just going to do a 15 pip attempt, do a full 2% risk, and I make it or I don't. Okay, if I don't, then there it is. Take a trade with 15 pips stop, 15 pips your first lock in. So if it goes to 15 pips, you're sitting on a gravy train. It's going to give you nothing, stop out, break even. Or if the trade materializes and unfolds more, you lock in your 15 pips where it's available, and you just let it run. This model is not designed to lock you into the state of mind that 25 pips is all there is. That's your goal. But if you are limiting yourself, and this is not what I'm trying to teach you all this time, we're not trying to limit our potential reward. We're trying to limit our potential risk and manage that to a point of which where we can fund the position, that means take something out of it, and manage it in such a way where hopefully it could be managed to the degree that it allows us to get much more than 25 pips. So the model is that, yes, you're looking for the low-hanging fruit of 25 pips, yes. And if that's all you get, you're comfortable with that, you're content. There's no reason to be upset about it. That's not also to say that if you don't get your 25 pips that you should be upset. Don't be upset. Because there's so many setups that come to fruition over the course of 1 week. All you need is one pair. So if you focus your attention on that one pair and say you do something wrong, or you read it wrong, and you execute wrong, and it doesn't pan out profitably, that's not to say to throw away what you've learned or your approach. It just means come back next week. Now, it's going to take a lot of discipline for you to want to do that, and patience, and a lot of you are still cultivating that, but it's a necessity. Okay, so I want you to understand that 25 pips is absolutely doable. I think that anyone that goes through my free tutorials should have already arrived at that. That's what I personally believe. Now, it doesn't mean that all of you were in that boat when you first started in the mentorship. It just means that I have a great deal of expectation on the students that have gone through every single video I've ever produced and the free stuff. So here, this is kind of like to remind you how easy you want to keep it, and then over time, if you want to add more things to it, not to make it complicated, but to help you with your precision and your trade management. That's all the tools are designed to do. They're not trying to prevent you from having a loss because you're going to lose. It's not to prevent you from getting it wrong because you're going to get it wrong. It's not to help you believe that you're going to be better than me or 25 other people that's trying to do a $1,000 contest on Twitter. It's irrelevant. All you're trying to do is be better than you were yesterday. Over time, if you keep that up, believe me, you're going to be in a phenomenal state of being for a trader. So the weekly range expansion, we're looking for bullish or bearishness, okay? And what defines that? Everything that we've taught in terms of institutional order flow, you're applying it to the weekly chart. Okay, so what we're looking at is basically month 12 content, that top-down analysis, that processing of the higher time frame down to the lower time frame, but we're focusing primarily on what that weekly chart is suggesting to us. Is it bullish? Is it bearish? Okay, by that, without going through all of the 12 months of content of mentorship, because that's not what these profiles and price action models are intended to do, because you should already have a bank of understanding and a well of resources in your mind and retention of what has already been taught to you. So when I talk to you, you have now the same language. And that's what this whole process has been, the 12 months core content. So it allows me to sit back in a leisurely way like this and talk to you in a comfortable tone, in a comfortable manner, where I'm not trying to get, technically, lofty with my my speech. Not that it's the requirement or that I can do that. But we're looking at the weekly range expansion. And the purpose of the weekly range is because if we were to say that the average weekly range is 150 to 200 pips a week. Now, that's not to say go right out there and start measuring and come back to no, it's not like that. I'm saying from my personal opinion, that's what I think of the market every single week. Does it deliver that many pips? No. Like if you file one currency pair, is it going to consistently give you 150 to 200 pips a week from high to low? No, it's not. But that's how I internalize it. So if I'm only looking for 25 pips, or if I'm trying to instill in you the thought process that you're only looking for 25 pips amongst 150 to 200 pips a week, are you expecting a whole lot? No, you're not. And that's exactly what you want to have in mind as a consistently profitable, professional trader. Let's just call it that. Because you're trying to do things that are easily repeated consistently, not trying to get an Olympic feat of gold medal status every single trading encounter that you have in the marketplace. But that's highly unreasonable. Okay, it's not something you should expect. So just know that what we are discussing here is achievable. All of you have the ability to do this. The problem is sometimes when you do it, you don't feel it's enough because you're on social media, you watch me do something, and it's like, well, I need to really show him, in other words, you want to impress me. Don't worry about impressing me. Okay, don't impress me. It's not about impressing me. You need to impress upon yourself the due diligence that is necessary for you to do what is required and be content with enough. Okay, and 25 pips a week is enough. So we look for the weekly range to expand to the bullish side or bear side. Seasonals can help in this regard. We've obviously given lots of key points of the year where certain markets are more inclined to go higher or lower relative to their seasonal tendency, but again, it's not a panacea. There's obviously, with this model, there's no need to call the weekly high and low, which is a great deal of liberty there because some of you are still demanding that of yourselves, and you have to grow into that. Okay, watch out one kill. We'll cover that in model 9, which is after this one, and we'll talk about things that help you do that. But we're looking for bread and butter setups. These things that repeat every single week, and not requiring the absolute high of the week or the low of the week. We're just looking for that little pound of flesh in the middle, the easy, reachable fruit. Okay, we're not limiting again ourselves to 25 pips a week. What we're looking for is one good entry inside of the weekly range. We're going to be able to fund our position, in other words, lock in 25 pips, and then allow it to grow from there. This model, we're not trying to bank anything right away. We're not trying to say, okay, well, I'm going to take partials here. That's not what we're doing in this model. This model, we're looking to lock in 25 pips. So what does that mean? We're looking for an opportunity for the market to move beyond 25 pips, have a retracement, and then expand again. And then we can lock in 25 pips. Then we can take profits on partials above 40 pips and 60 pips and 80 pips if it allows us to do something like that. But we're only really trying to manage the position initially to remove the risk and lock in 25 pips. Once that's done, we've met our objective for the week. Then anything happens beyond that is a bonus. So our majority of our focus is going to be on where the market's reaching within the next 50 to 75 pips inside that weekly expansion. So if we're looking at the reasonable possibility that 150 to 200 pips can occur on a weekly expansion, okay, and again, I'm really focusing on the times when the market is predisposed to go higher or lower. There's going to be times when it's not going to look like it's going to be moving. For instance, like we discussed about cable, it's going to probably stay in a range-bound condition. Do you really want to be looking for your 25 pips in that environment? Probably not. Some of you are going to try to do it, and you're going to regret it, but you shouldn't always try to push it. So if we're focusing our attention on where that market's going to reach in the next 50 to 75 pips, can you get 1/3 of that range or 1/2 of that range? I'm believing that you can. You really can do it if you're trading inside that range on a weekly basis, and you're staying in that range from Sunday's open to Friday's close with respect to if we can agree on that 150 to 200 pips a week is the probable range. Not it's going to happen, it's not an average range, it's always doing it. It's just a probable scenario. So it helps me communicate to you that while 25 pips is not minuscule, it is modest in terms of the grand scheme of the potential range that can occur over the weekly time frame. So if we look at the setups, what we're looking for is the day of week. Okay, and when I said earlier that we don't require being in at the high or the low of the week, we don't need that, because let the professionals price that in, because we have tools that will allow us to get in sync with that and then ride the coattails. We're not trying to be smarter than them. We're not trying to beat them to the punch. Yeah, I caught the high. I was in 2 pips away from the high, or I called the high. Okay, it's not what this model's focus is. It's designed to get you in a consistent way of thinking and harvesting 25 pips every single week, and allowing it to grow from 25 pips inside of the range of the weekly range. What I mean by day of the week setup, we're looking for the daily high on a Monday, Tuesday, or Wednesday to form, and also provide that overlap of the weekly high or low. So if we're bullish, we're expecting a weekly range expansion on the upside. We're looking for the Monday, Tuesday, or Wednesday low. Once that forms, let it form. We're not trying to chase it. We're not trying to nail it down. We're waiting for it to form. Now, there's things that we've covered in the mentorship that helps facilitate that, and I'm going to talk about some of those things when we get into the charts, but we're not requiring this model to put us in at the high of the week on a bearish week or the low of the week on a bullish week. It's not necessary. Again, the small portion of 25 pips, that's all we're trying to capture here. And if you do the math on it, using compound interest, that's the benefit of this model. Not doing a whole lot, not working really hard to get it, but letting the numbers do all the work. And the pattern that we're going to be focusing on is inefficiencies. It's inefficiencies, fair value gaps and liquidity voids, and runs on liquidity into pools of liquidity. Okay, so again, from a graphic depiction, what we have here is a range expansion. We're looking for the next 50 to 100 pips. Okay, where are we going in that next 50 to 100 pips? I originally taught this model like this, but I want to kind of like bring it back a little bit to 75 pips, which helps also segue into price action model number 9, which is obviously one shot, one kill. The weekly range expansion, what we're trying to do is identify the likely or most probable direction of the next weekly bar or candle, and then what direction it's going to expand in. The day of the week, we're expecting an anchor point to form on a Monday, Tuesday, or Wednesday in order to frame a trade setup. Now, that means we're looking for an anchor point to start the idea of our PD array matrix. If we're waiting for a bearish scenario to unfold, in other words, a weekly expansion to the downside, we're looking for a high to form on Monday, Tuesday, or Wednesday. If, for instance, as this example shows here in the little chart, Monday's consolidation, Tuesday starts to drop down, which obviously doesn't really give you a retracement of any kind into a kill zone, But Wednesday, we punch up into the equal highs that were formed on Monday. So Wednesday creates the probable high of the week. That means we can trade on Thursday. Yeah, think about that. Thursday. We don't need to be in on Monday. We don't need to be on Tuesday. We don't need to be on Wednesday. But you said the high and low forms on Monday. Yes, it does. It does. But you don't have to be in at the high of the week in a bearish week. You don't have to be. Stop forcing yourself in an unrealistic mold. Grow into those things. Make those long-term goals for your career. But right now, it's not reasonable for you to expect to be able to do that on a consistent basis. Stop with all the high and lofty ideas. Just because you're going through the core content doesn't make you a master trader. You have to grow into that. And you start with reasonable, low ideas like this and then grow from them. And then obviously the inefficiency in liquidity runs is we're utilizing gaps in liquidity. And again, it's fair value gaps and voids. And liquidity pools to facilitate an entry in the direction of the weekly expansion framed on anchor points from Monday, Tuesday, or Wednesday. And again, I say anchor points here because I know what you're thinking. Well, what's an anchor point? I don't remember hearing about that. All I'm stating is that you're going to be utilizing on a bearish week, or expected to see a bearish week expansion to the downside. You're going to be looking at Monday's high, Tuesday's high, or Wednesday's high. Okay, and then you're going to be looking for movements away from that high down, and then looking for inefficiencies in that range. And then you'll be targeting the liquidity below old lows. That's all you're framing. It's really simple. Okay, really, really simple. If we know that the market is probably going to go lower, and we make a higher high on Wednesday, as we see in this example here, that means that Wednesday has a high probability of creating the high of the week. That's beneficial for us if we're doing one shot, one kill. But again, this is focusing primarily on looking for 25 pips inside that weekly range. So if we take a look at this chart here, and this is actually the dollar Swiss, and I have mapped out here a few things showing you the day of the week, Monday, Tuesday, and Wednesday, a liquidity pool that was targeted for a potential scenario. If we look to go lower on the weekly range, obviously we can expect a weekly Judas swing or a weekly protraction to the upside, neutralizing any buy stop liquidity, inducing buyers. So that way it builds a larger liquidity pool below the marketplace, below old lows in the form of sell stops. Once we see Wednesday break down, it creates a fair value gap. So on Thursday, we see that market protraction on the upside, Judas swing, and boom, runs right up into the fair value gap, creating your classic sell day for intraday templates. Targeting a liquidity run in the form of a sell stop liquidity pool. We have a 30 pip grade mapped out here. It's just a little bit over 30 pips. That actually makes that spike low. But it was a 30 pip run below that old low. It expands wider than our typical 10, 20, 30 pips because it's in the direction of our expected weekly range expansion. So when we're looking at this model, we're not just saying if we get in around that 99.85 level on Thursday, December 6th in London, trading into that fair value gap that was formed on Wednesday, because we have a full-fledged market structure break on Wednesday's low when we trade into Asia on Thursday, on December 6th. Then we have the Judas swing up. Everyone in the retail world gets excited about that, but all it's doing is trading back to fair value. So 99.85, 99.90 in that area. We could be a seller, and it creates an optimal trade entry for a later entry pattern. Again, trading around that 99.80 institutional level. So it's a failure swing there. Trading at the butt end of the fair value gap. And that's seen right here. So we have this market move here, and then it finally gets up to goes and targets what? The lows here and the low of the week. As you would expect on a weekly downside expansion, it's going to target the large liquidity pool that it created here. So this is engineered liquidity. This repeats so many times. It doesn't matter if you focus on one pair, for the rest of your career. Initially you want to, but over time, you'll be able to go through quickly just about every single currency pair. If you're looking through the pattern like this, you'll just go through every single one of them. Lickety split. I mean, it takes no time to find these setups. So you'll be able to find something every single week to get you 25 pips. Doesn't mean you try to do it every single day. Okay, so this here again is dollar Swiss. We'll take a closer look now of what this offered. Here is the dollar Swiss weekly chart. Okay, and I want you to take a look at it before I show you any more detail. And what do you see? Well, right away you should see there's equal highs right there, and right above them, you know what would be resting there is buy stops. So we see the price action run those buy stops, and then it came back. Then we saw price trade back below those equal highs. So given the market conditions right now, look at that chart, what would you expect to see? Well, with this model, what we're doing is we're trying to frame on a weekly basis where is the price most likely going to expand to. Well, we're going to be looking for a rebalancing of sorts because we pressed to equal highs, we've expanded the range, and now chances are it's going to want to go back down inside of its previous range. Those buy stops being ran sets us up for a likely retracement. Why? Because it has not been able to stay above those equal highs. So that's a raid. So now what are we looking for? Inefficiencies below the marketplace. Right in here, we have our last reference point where buy side was offered, but then sell side was offered later on. In other words, we have the high form that's being noted where that anchor point is here. So we traded higher, and then from the high down to the close, we had sell side delivery. The next candle opens, we offered sell side delivery again, and then expanded up. So I'm using this high here, which is basically the same as that opening. That's our initial level of balancing, if you will. Then below it, we have this candle here. Why not this one, Michael? Because all of these candles are all consecutive. So this is the highest one inside that range where buy side was offered before this candle went beyond it. Now, if we broke lower than this one, this is so close I wouldn't even consider it. Then I would go to this one. But we start off with reasonable levels like this. So if price trades down to these, okay, we could recalibrate and rebalance price action as a downside objective. In other words, we're looking for a weekly range to draw to this, try to get down to it. So we framed our ideal scenario. We're looking for bearish weeks, not weeks, because now we have this objective in mind where we can rebalance. Why not continuously go higher? It could, and we could be wrong doing this. But given the context of what's being shown here in the chart, it favors the likelihood of wanting to go down here and rebalance. Going forward, this was the result of it. We have this nice big down week here. Then we have a nice big run up week. And then we have a down week and then another down week. Inside of this range, this high and this high, this is our fair value gap or inefficiency. Okay, so we have buy side imbalance, sell side inefficiency. That means there has not been enough sell side offered inside of this range. The midpoint of that, okay, is consequent encroachment. New thing for your library scratch pad. With order blocks, the middle of it, we refer to it as mean threshold. When we're looking at a fair value gap or a range of fair value, the midpoint of that is called consequent encroachment. And what that means is this is expected and it could stop there and still be considered filling fair value. We would expect it to get down to the lower end, but if it goes here, it's acceptable. Okay, so when we're dealing with fair value gaps or liquidity voids, when it goes to the middle of that gap, it's called consequent encroachment. It's permissible in terms of allowing that as being sufficient, and it doesn't have to go any lower than that. Okay, again, if we're looking at order blocks, it's mean threshold for the equilibrium price point in the middle. In fair value gaps, entry term is consequent encroachment. So price trades down to that. Now, once we have these levels in mind and what we're looking for, each week we're looking for this scenario to unfold. Now, this week didn't create a down close week, and we'll look at that when we get into the intraday portions of this teaching. But we have this week here, and then finally gets down into it. So it builds a lot of the understanding of, tell me the bias, which directions the market going to trade in. You start on a weekly chart. It'll tell you what you need to be focusing on. But the problem is you'll look at a weekly chart, and because it takes so long to develop and create a close on that candle basis on a weekly chart, you're not interested in that. Give me a 1 minute chart, give me a 5 minute chart, it's more exciting. You want to be consistent, you can start with these higher time frames because it's going to give you your model. Okay, are you a buy program or a sell program? If you're going to be a buyer, you focus on certain things that you look for intraday, intra-week to be a buyer, and stick with that narrative regardless if it takes you out. If it stops you out, so what? You just got in at the wrong time. It does not change the narrative generally on a weekly chart if you traded a 15-minute entry. It doesn't change that. It just means you did something wrong, or entered too quickly, or waited too long, or you just put your stop loss in the wrong spot, or you just read it wrong. Period. Or you didn't do something ahead of economic news that a driver comes out and boom, bang your stop. Then it probably unfolds later on. So let's go into the charts and take a closer look at this, and we'll see how this model pans out. Okay, so we have our chart on a 15-minute basis, and we're looking at that same underlying dollar Swiss scenario. You can see the buy stops were ran over here on Monday's high, and I've included the weekly open, so you can see our weekly protractionary move due to swing here, here. Again, all of this reach above the opening price. This is classic institutional selling. Look at all of this price action above all these highs. That was distribution. When you frame it in the context as we've done so far in this model, it's easy to see. Now, obviously, we have the benefit of hindsight, but you'll see by practicing this and studying it, it repeats almost every single week. It happens everywhere. Some commodity or some currency or some stock or some index, something will work like this. The problem is, it's obviously, if you have 1,000 darts and you throw them at a wall, you're going to get a bullseye eventually. I'm not trying to promote that idea. I'm saying that if we have the likelihood of reading price action accurately over time, building experience, you will see these things. It's not imperative that you get it right every single week, nailing the high and the low. Again, that's not what we're trying to do here. We want to see where it will likely form. Now, if we are looking for a weekly bearish expansion, and we see it on Monday here, but doesn't really retrace back up into anything until Tuesday, this run up in here is outside and beyond the scope of the New York session. So the run above Monday's high and Tuesday's high on Wednesday sets the tone for what profile for the week. High of the week Wednesday. Market comes down on Thursday, as you expect. We're not chasing price on the low end. We want to see it go up. Well, what's the level we're looking for? Well, we have a range. The low that creates here prior to this run up, we have this high and this low. There's our anchor point here on Wednesday to the low that's formed prior to this run up. This gives us our PD array matrix framework. So if you put our fib on, again, it's not to look at Fibonacci because IPTA's not really working off of optimal trade entries. Optimal trade entries is an easy way for me to communicate to my kids. And obviously now, as a result of you being here and being my student, you learning also the element of discount and premium. So here, equilibrium, our anchor point is here. Thursday creates the initial drop down. We're not chasing it. We don't want to see that. We see price rally up to a premium array in the form of a fair value gap. Also trades up into, as you would expect, optimal trade entry and above equilibrium. So we're in a premium here. Where is price going to reach for? Discount. What is the discount arrays that we'd be looking for? Well, we have a gap in here. We have the down close candle here for bullish order block. The rejection block. We have vacuum block. We have the old low then the sell stops resting below it, and then we have the old low over here, and all the PD arrays that are in here. But because we are working with the context of a weekly expansion, we're not going to nickel and dime the market saying, okay, well, it's going to get to here and I'll take some profits off here, or we're going to take something off over here. No, we're looking for this run on this low. We're expecting the weekly range to expand beyond what's already been made Monday, Tuesday, and Wednesday, because really it's nothing but consolidation. And this is actually a better thing to see on Wednesday, making a higher high, running the weekly high out, Monday's equal high, Tuesday's high. All of this is distribution, and it's above the weekly open, so we see our weekly Judas swing. Every time it rallies back above the weekly open, that's just allowing them to do one more level of selling short. So this is the target here. Now, once it gets below here, like below the running stops, that's where we can look to scale out portions above and beyond the 25 pips. What you need to train your eye to do with this model is, this is 25 pips in a graphic depiction of a range. So this is all you need. So you're training to teach your eye to see, where is this in this chart? Okay, and this is the perspective I have for the lesson. It may not be like this when I'm actually trading. It may be a little bit further out. I feel like I have a little more data. But if we're looking to go short here, inside this fair value gap, using the low end of the fair value gap, low hanging fruit, it doesn't even need to get below this low, which is what we would be targeting initially, to give us the 25 pips. See that? So when we get short here, or on this optimal trade entry here, because it still fits the criteria, we're above equilibrium, anchor point from Wednesday, the range is defined here. Again, we're looking for a weekly expansion on the downside. So we're not looking at this 15-minute chart and getting hypnotized by it saying, well, I might want to be a buyer. No, we're sticking with the narrative that's been derived on the weekly chart. Optimal trade entry here or here. Fair value gap, the better one. Once it goes below here, we're locking in 25 pips. We're done. We're not taking partials until we get below here. Why? Because it's expanded the weekly range now. The weekly range has only been defined by the low of the week here on Tuesday. Well, we have Thursday and Friday still. So we want to take some profits below here. Keep our stop locked in at 25 pips. All of this is where we take profits at. If we get 10 pips below it, take something off. If you get 20 pips below it, take something off. If you get 30 pips below it, take something off. Then when you sit through this retracement, you're not worried about it. It knocks you out with the remaining balance of 25 pips on that open position that's been left on after partials have been taken below here. You're not worried about that. And if you are, you got to get over that. But we are able to leave to stop it at 25 pips, locked in, and allow all this to happen later on. So on Friday, we make a lower low on the week. Not by much, but still nonetheless. As soon as we take that low here out, take something off again. Or close the entire trade. Now, if we're in a position trade, or swing trading, this entry back here, you just put it in there, lock in 25 pips as your entry model, because you can use this model to get in your long-term swing trades. How about that? You need to give me 15 different trading models, Michael, to do swing trading. No, I don't. I've given you everything already in the mentorship. I'm just giving you framework and foundation in these price action models to get you thinking what you already learned, where you plug and play those things. That's what these price action models do. They're merely suggestions to help you formulate your own unique approach. So this range here, again, is the 25 pips. If we looked at the idea of this being a breaker, because it is, we have a high, a low, and high. Higher high than the previous one. So if we have a high that's higher than the previous high, what's the low in between? Right here. Lowest down close candle. Here. Use the body. Right there. Close is 99.35. So if we trade back up into it, not the time of day to do it here, but it is here. We can trade short here. And what are we going to do now? If we get short there, I'm saying if you missed it over here, not to take another trade. If you get this one, don't do this one. You manage the one you have. But you can still use the framework here. Friday, trading on Friday, yeah. You're only looking for 25 pips. Trades up into the breaker. Here. Okay. That would be right there. Alright, so your entry is here. Where do you put your stop at? Well, go back. What are you looking at? You have a void in here. Bear shoulder block. So your stop has to be above that. Okay. So we're not even talking about 20 pips. It's not even 20 pips of an entry. To stop is not even 20 pips. So we can frame that here with that. But what's our target? What's the model tell us? We're targeting runs on liquidity. What is that? Well, we're expecting a weekly expansion down. That's this old well. So 25 pips, we lock it in. And here, once we get below this price point here, we got 25 pips. It's done. Well, it stops you out here. So what? You got 25 pips. That's what the model is designed to do. But if you go in and you get short and you go, come hell or high water, I'm leaving my stop here and I want to get the run on this liquidity here. That's my target. Well, then you get it here. Your stop has to stay up here, less than 20 pips risk. But look what you're getting. You're getting essentially almost 50 pips. Not quite 50 pips, but you're real close to it. So the model is designed to get you thinking in terms of how can you get your 25 pips using what you've already learned. We're looking for fair value gap to frame trade or liquidity voids off of an anchor point. So initially when guys learned from me on baby pips, it was just let's draw optimal trade entries and use the fit. That's not what I was doing. I was teaching you to look at things conceptually from a premium to discount without teaching that. The optimal trade entry, by default, is always going to be in the ideal premium or ideal discount level. But it doesn't work, and it will not work with a fib unless it has these elements to it, like a fair value gap. That's what makes it want to go back up there. And the question I get is, why does this price need to go back up there? Because this is fair value. There has been too much selling in here, so it's a sell-side imbalance, buy-side inefficiency. Too much selling, not enough buying offered. So the price wants to come back up to it. Look real close and you'll see what I already taught you at the beginning of this video. Consequent encroachment. Middle of the gap. That's what you can do, and it's enough. I enter at the bottom of the gap. I allow for this. Ultimately, it can come here, and my stop needs to be above it. What's it going to be? The rejection block over here. The highs up close. That's where your stop would be. Very reasonable. Especially if you're looking at it in the context of if this is your entry point here, and you're looking for a stop loss of there. Right about there. Yeah, right there. Okay, this is what you're taking on as risk. And your goal on the trade, obviously, is 25 pips from net week. But you're looking for a run below here. So even if you get just a poke below that, it's better than 55 pips. With a risk initially of less than 12 pips. Come on. Think about it. Think about the extra 5 to 1. I mean, well, you teach me how to do 5 to 1 trade setups. No, don't. I already did. I already did all that. You need to go through the charts and start looking at what I've already taught you. You're trying to complicate it, and that's the problem. Because I've given you a great deal of information. But you don't understand is that great deal of information, that 12 months core content, you think is over analyzing too much stuff, too many moving parts, and there's going to be 50 million things that we got to learn beyond that too. No. It's how you use those things and how I can teach you to fine tune them where they're going to speak volumes of insights. Everything else beyond these 12 months that you've gone through are all going to be experience based, with me pointing out certain things that's going to be like, oh yeah, now I get that. Now I understand that. See, you're supposed to know everything generally, but now what we do with that information and where to put that information in terms of trading, when not to do this, when to do it, when's it better to do it, when's it not so good to do it. Those are the things that you learn from experience, and that's what the whole membership is about. You know, you're here now, and we get to talk about things and build on your understanding that will eventually lead to a greater appreciation of what you've gone through. So hopefully you found this insightful, and I will catch up with you guys next time in Price Action Model number 9.